So good morning, my colleagues, and I just want to go through the Chapter 4 cash budget and how it's prepared. So I want to, pick up right here. And here is the general form of the cash budget. And it should be pretty obvious because I'm sure many of you do a cash budget at home. And so let me just highlight that, all right? And all right. So if you look here, here's the months, right? So here's your receipts. And this would be equivalent to what? Like your paycheck, right? That you got in the morning, right? And total cash disbursements would be what? Your bills, right? Like pretend this is your checking account, right? So that leaves you what's ever remaining, your net cash flow, okay? Now, there may be a spillover. There may be a spillover from last month where you didn't use all your cash, and that would be the beginning cash for this month. Is everybody clear? So when you add that to your net cash flow, here's your ending cash. Okay? Now, what you may do is you may decide, well, I got to keep like $50 or $100 out of the ledger and hidden in case an emergency comes up, right? So you're going to subtract that off and say, even though I really have $1,000 in my checking account, I'm only going to put down I have 900 because I don't want to bounce a check, or if something happens, it's an emergency fund. So you're going to subtract off the minimum cash balance. Notice you add your beginning cash here, but you subtract off your minimum cash, right? So that leaves you with what's ever left, okay? And you do that for each month. Now, notice your ending cash becomes your beginning cash for the next month. Everyone see that? So you just keep carrying that over, okay? All right, so here's a typical schedule of cash receipts, right? And the first thing is we got to make a table for this, and then we got to make a table for that. So table 4.8 covers the receipts, okay? You see what it says? A schedule of projected cash receipts. So that will cover this, okay? And here is the sales. And basically, here's the accounts receivable. Now, some of these people are going to pay you 50% 1 month later, and some are going to pay you 30% 2 months later. You may allow that, okay? So here's the total cash receipts, and you're just adding these up. Everyone see that? 20%, 90 is this. So you just keep adding these columns, okay? So I'll make sure everyone's clear about what it means by lagged 1 month. Sometimes people pay their bills a little late, right? And you may allow that, right? Like if sometimes people say, well, you can pay your rent a little late or something, right? All right, now here's the disbursements, right? Here's the disbursements. So as I said, that covers this right here, okay? Disbursements. So now we got two tables, and this is telling us what we have to pay out, in disbursements, right? All right, so this is what we bought, right? Notice that it's 70% of sales, okay? So what was sales? Sales was, the forecasted was 100, and 70% of that would give us 70, right? Everyone see where this numbers are coming from right here? Take 70% of these numbers, okay? Just want to make sure everyone's clear about that. And then the cash purchases, you do 10% of your sales, right? So you're doing 10% of these you paid in cash, all right? Here's your accounts payable. Again, there's a 1 month and a 2 month lag, okay? Right? They may give you, a month or two to pay your bills, right? Just like people are paying you a month or 2 months late. All right, so that's good. And here's all the other items, rent and whatever bills you may have. And again, you add all those up, okay? So you get the total here of all your disbursements, okay? And those two tables now, you can see the numbers here. They get reflected right here. Right now, this is the forecast columns. You notice they're showing you October, November, and December. You see right here? October, November, and December. And here's the receipts. So we're just doing the forecasted. Okay? And so you subtract those, right? And then here's your beginning cash. Right now we're filling in the cash budget that we had up here, right? Once we got these numbers up here, we can continue. Because this is all given to us, okay? All these items are given. And you'll notice there's a cash balance here, right? Excess cash balance. But over here, we have to finance. We're in a hole here, right? We're in a hole. So we've got a $22,000 excess cash balance, right? But here we have to finance. We're in trouble, right? Notice how they're carrying the ending cash to the beginning cash. And that's reflecting this also, okay? So here's the write-up on the cash receipts, right? And that includes all the inflows of cash during a given period, right? So here's your sales, your collections, right? And your other cash receipts. So if anybody has any questions, email me about this all the time, as I always tell you. And so here's the example we kind of just did, right? All right, so here's the disbursements, and here's the items that are dispersed. Okay, so, all right, so again, here's all the numbers from the example I just kind of did. Okay, this was a Colson Industries, and they want to do a forecast for. Remember, this is a forecast for October, November, and December. So they're forecasting. And of course, we go now and we do, and they go through this in great detail, and I kind of went through it up there. Okay. So here's the summary of all their numbers. Notice here was the excess cash, and here was the money they had to borrow. Okay. So I kind of went through that up there, and it's pretty straightforward. It's like keeping a checking account. And here they talk about that right here. So here's a personal finance example of a cash budget. So they make a comment here. They're just as important to individuals. Right? So here you have a surplus. And here you have deficits for your personal cash budget. All right, and here's your cumulative. If you subtract that from that, you'll have this, right? So here's your deficit, right? I'm sorry, here's your extra surplus you have left, right? And then you take that surplus and add it to that, and this is what your deficit is, all right? Okay, so now there's uncertainty because sometimes your forecasts are not right, right? Sometimes your forecasts, and we all make mistakes, right? All right, so what they do is with regard to that, they'll make 3 columns and they'll say, well, here's my most likely, which we just did, right? This is what we just accomplished, right? The most likely is what we just calculated, right? Everyone see that? Now, if I'm wrong and I'm wrong in the negative direction, that's the pessimistic side. All right, we'll highlight that. And we'll highlight that because I screwed up in a negative way. All right. But if things are better than I thought, and I'm optimistic, we'll make that the pink, then that's the third column. So all we're going to do is we're going to go through these numbers again. Okay? So here's the total cash with now 3 different numbers for each month. And what we do is perform this whole thing all over again. Okay? So you do it 3 times. And this lends itself really nice to an Excel spreadsheet. Okay? So this would work great with an Excel spreadsheet. And, you could do some kind of simulation with Excel. Okay, so that pretty much covers how the simplicity of putting together a cash budget. Okay, so now we're going to kind of look at putting a pro forma statement together. Pro forma means a forecasted future statement, right? Let's click on that and see what that means. Projected or forecast income statements and balance sheets. That's the word pro forma. Okay. So here's the previous year's financial statements. And this is real numbers, but you know this because it was the preceding year. Okay. And you sold some product, I don't know, mugs and plates here at different prices. Okay. So, you've got those numbers, right? Okay, so this is the income statement. All right, so here's your true income statement that you know about. All right, so we've got that, and we've also got the true balance sheet. So we know these 2 items from the previous year. Everyone clear about that? So we know that. Now when we want to forecast what's going to happen. Now, remember the word forecast means we don't know. We're taking a shot. We're looking into the crystal ball. Okay. So here's our forecast for fair traders. And you're going to increase the price because of anticipated rises in your cost to buy, raw materials, right? So you can see there's an increase in price here, right? And here's how many mugs you forecast and plates that you're going to sell at the new price. Okay? You're going to sell these at the new price. So here's your forecasted sales total based on, after I raise the price, but I still think I'm going to sell these many. All right? So you do that. So now you're going to take those forecasted sales is you take the original cost of goods sold and you say, well, my original numbers from my previous year that I definitely know, this is the ratio of cost of goods sold to sales. So it represents 80% of my ratio. And now you're going to take all these known numbers and you're going to create ratios these percentages or ratios out of them. And you're going to apply these to your forecasted number, okay? So let's look at this table. So now this was your forecasted revenue that we calculated based on the new prices, right? And now you say, well, if I still make 80%, my cost of goods sold should now be this new number right here. 80% of 135,000 is 108,000. And you just keep taking these ratios you calculated and apply it to your pro forma. Now remember, this is a pro forma or forecasted income statement, and we're using the percentage of sales method that we calculated up on top. Okay? And you just keep applying those percentages. You see, here they are, 80%, right? And 10% is here. Right, and you just plug away on those forecasted numbers, and the tax rate doesn't change, I believe, right? I believe they can consider that, and you come up with your whole new pro forma income statement, and here's your net profit after taxes, okay? And again, this is pro forma on what you believe it's going to be. All right. Okay, so here's what we have. And now here's when it gets a little more difficult. Sometimes your costs are not fixed. And you'll notice now this 80,000 is broken up into two components. A fixed cost, right? And a variable cost. And that's 40% of the sales, okay? So now your cost of goods sold has two components. I want to make sure everyone's clear about that, all right? And so look at your operating expenses here. Again, there's a variable cost and a fixed cost, okay? We'll make that. Whoops, we'll make that. And here's the fixed cost. Okay, so in this example, now the net profit after taxes are these numbers based on the fact that you got fixed and variable costs. Okay? So this puts a little wrinkle into the problem in that you've got some variable costs. And you can see the ratios here for variable expenses, all right? But it's no different. You just got the two components. So you notice here it's broken into fixed and variable cost and expense components. All right. So this is going to give us, as they say, a more accurate projection of its pro forma or forecasted profit. Okay. So that gives us a more accurate projection here. All right, so let's watch this video here, and we'll end this here.
Firms regularly prepare pro forma income statements to project the profit that they will earn in an upcoming quarter or year. The simplest way to do this is called the percentage of sales method. Under this method, the pro forma income statement begins with a sales forecast, and then all other items on the income statement are assumed to be a fixed percentage of sales, where the percentages are derived using a prior period's income statement. Given those assumptions, a given percentage change in sales produces an identical percentage change in all costs and an identical percentage change in profits. While the percentage of sales method is not a bad place to start, we can improve that method by recognizing that some costs have both fixed and variable components. Our pro forma income statement for fair traders begins with a projected 35% increase in sales, or $135,000 in forecasted sales for next year. Looking down the income statement, we can identify Fair Traders' fixed costs and expenses. Fair Traders has $40,000 worth of fixed costs as part of cost of goods sold, $5,000 in fixed operating expenses, and $1,000 in fixed interest expense. These fixed components will not change with changes in sales, so they'll remain the same next year even though there's a forecasted increase in sales revenue. Both cost of goods sold and operating expenses on the pro forma income statement have variable components. Cost of goods sold has a variable cost that is 40% of sales, so for next year it's forecasted to be $54,000, while the variable operating expense is 5% of sales, or $6,750. Now, holding constant the fixed cost items and letting the variable costs and expenses grow with sales of 35%, we see that Fair Traders' increase in profits is much higher than 35%. Fair Traders' forecasted profits more than triple in response to the forecasted increase in sales. By modifying the percentage of sales approach to allow for some costs to vary and some to remain fixed, we get a better projection of the firm's future performance.